What is long butterfly? A long butterfly strategy is profitable if the future volatility is lower than the implied volatility. In long butterfly, investor is assuming that stock will trade flat or non-directional. So the first thing is assumption. You should assume that the stock will stay flat or non-directional. Now this is a tricky part because you never know if it will go straight or not. And that's where my plan comes in. Because my plan tells you if the stock have a higher chance of going straight or not. And as per my experience, 95% of the time it stays non-directional. And that's the best part. And that's what makes this course the best, because no other course offers you a plan. They only tell you how a long butterfly works. Now, when a butterfly spread is implemented, the gain is always higher than the potential loss. So you always have a higher winning chance. Always. However, both the gain and loss are always limited because this strategy is not a get rich quick strategy. This strategy is a monthly recurring income strategy where you play it and it gives you a monthly smaller limited profit potential, and you have a fairly limited loss chance. So at the end of the day, you're always making money. Yes, it will be far more smaller, but it will be recurring. A long butterfly spread is formed of 3 legs with 4 options. All the calls have the same expiration period, so they all expire at the same time and ends the strategy at that time. Whereas usually the middle strike is halfway between the lower and higher strikes. In long butterfly, 4 options are initiated with 3 strike prices. You buy, that is long 1 call with a strike price of X. You short 2 calls, that is you sell with a strike price of X. And then again you buy, that is long 1 call with strike price of X. Now whenever you buy or you are long, then you have to pay premium. Whenever you sell or short, you get premium. So the middle strike price 2 calls that you are selling or short, those strike prices, those options will pay you premium. And the other 2 options will demand premium from you. So basically this strategy comes to limited net debit transaction, because they basically cancel each other out and you are left with 30-50 cents net debit, that is you need to pay that. So it reduces the upfront payment as well. At expiry, the value of the butterfly is always 0. If the price of stock is below lower or higher strike prices, that is the call option, so it always ends the butterfly in 0. Because basically your loss is the initial net debit that you paid, 30-50 cents, whatever that is. So the butterfly is designed to be 0. Only the debit, premium that you paid upfront is lost, and you cannot lose any other thing. So the value of butterfly is always 0, nothing extra. Profitable. It is profitable if the price is above the lower and higher strike prices. So basically we need the price to be within that band. If it stays, we usually end up in profit. Max profit is achieved if the stock price expires at the middle strike price. So always try to find that price. If you find it, if your stock expires at that price, you get to keep the full profit potential. Thank you.